Hello, welcome back. So in today's video, I'll be talking about quality stocks that are crashing. So in today's video, I'll be covering a few things. We'll be covering Visa and Mastercard crashing, Adobe's earnings, as well as some questions that you guys have left me in the comment section below. So let's talk about Visa and Mastercard first. Today, Visa and Mastercard, they're down around 5% each. Visa is down around 6% and Mastercard is down around 5%. So why is Visa and Mastercard down? Visa and Mastercard are down because of this Wall Street Journal article over here. So Amazon and Walmart weigh issuing own stablecoins, and that will affect Visa's as well as Mastercard revenue. So the article states that some of the biggest merchants are exploring how to issue or use stablecoins, potentially shifting the high volumes of cash and card transaction that they handle outside of the traditional financial system and saving them billions of dollars in fees. Walmart and Amazon, as well as other multinational giants, have recently explored whether or not to issue their own stablecoins in the US. Expedia and other companies are doing the same thing as well. So that is causing Visa and Mastercard to dip, and the market is reacting this way. So the market thinks that if this happens, then more and more merchants will start accepting payment processing methods through stablecoins, and then less people will use Visa, and then the company will fall. But this is actually a first level thinking process. The truth is that the consumer will choose which payment method to use. So the question then lies in whether or not the consumer will switch to your stablecoins. So will there be enough trust when it comes to your stablecoins? Is there any incentive for the consumer? Probably not for your consumer. And the incentives are for the merchants to avoid payment processing fees, but the benefit for the consumer is actually quite limited. So the consumers will still have to pick the most reliable payment processor and payment methods, and it's impossible for you to displace Visa and Mastercard. So these two companies, they are high quality compounding machines, and I don't see them being displaced anytime soon. And PayPal, for example, they came out with their own stable coin. So they came out with their stable coin in 2023, and currently the stable coin has a market cap of only around $1 billion. And as a share of PayPal's business is less than 1% of their total revenue. So it clearly shows that the adoption rate is extremely low because no one trusts it. And that is why I don't see any of these harming Visa and Mastercard's business. So for Visa and Mastercard, they also have their own stablecoins as well. So Mastercard over here unveiling their end-to-end capabilities to power stablecoin transactions. So clearly Visa and Mastercard are trying to go into this industry and this market as well to try and gain share in this segment. So for Visa, currently the stock now is slightly overvalued. So this is my DCF calculation for Visa. Assuming an 11% growth rate from year 1 to year 10, the fair value for this company will be around $303 a share. So currently now it's trading at $350 a share, so it's quite overvalued. I would like to add Visa when it's a bit lower. Currently now it's still quite overvalued for my liking. Next one is Mastercard. So for Mastercard, assuming a 12% free cash flow growth rate from year 1 to year 10, the stock now has a fair value of around $539 a share. So same story as Visa, Mastercard is now slightly overvalued. I would like to add this company lower down, and currently now it's not trading at fair value yet, despite this drop today. So for Visa and Mastercard, they are still overpriced. These are high quality compounders, and I'm comfortable adding them at fair value. I'll add Visa at around $300 a share, and I'll add Mastercard at around $500 a share. Those will be my buy entries for this stock, and hopefully it gets there someday. Let's see what happens after a while. Next portion, I'll be talking about Adobe's earnings. So Adobe actually released their earnings, and after the earnings itself, the stock went down by around 5% or so. So Adobe is currently now down around 12% year to date, and it is trading at a 25 times earnings. So for Adobe, it is currently trading at one of its lowest historical valuation in its history. In fact, it is the lowest valuation. It is currently now trading at a 24 to 25 times earnings. And the company has never traded at this low a valuation ever since it swapped to a subscription business model. So for Adobe, they reviewed their Q2 results, exceeding analyst expectation. The firm reported earnings of $5.06 per share on revenue of $5.9 billion, surpassing the consensus estimate of $4.97 per share and $5.8 billion of revenue. So Adobe, on top of that, they also raised their guidance as well, but the streets didn't like it. So for Adobe, the problem in this business itself is it is facing a lot of headwinds in the AI segment. So Kelshi just aired their first $2,000 fully AI generated ad on NBA Finals, and this was done with Google's Veo 3. So generative AI is growing rapidly, and for Adobe, it is currently not adopting it yet, and that is the problem with the business. That is hurting its narrative itself. So the markets are now pricing in that Adobe cannot keep up with all this AI innovation, and it is lagging behind, which will eventually lead to their share being taken away. So for Adobe, on top of their net income growth, the company is also doing a lot of buyback. So the buyback yield now is around 6%. So on top of the earnings growth itself, there's buyback growth as well. So when you do more buybacks, what happens is there'll be less shares, and this will inflate the EPS for Adobe. So overall, on top of the net income growth, you can also expect buybacks to inflate the earnings of this company. And that's why you're seeing EPS growth of upwards of 10% for Adobe as well. But for Adobe, it is currently facing a lot of long-term headwinds. If the company fails to integrate the best generative AI model into its own suite of products, it will lose share to competitors like Google's Veo 3. So besides generative AI, Adobe faces a lot of competition from Canva, as well as all your different other software editing platforms. And for Adobe, they've been very reliant on price growth itself and not so much the volume growth for their products. And they may end up pricing their consumers out of the products itself. So if they continue squeezing the consumers could push back, and that could lead to volume decline for Adobe. So for Adobe, although the numbers look great, the problem with the business itself is in the long run, I believe that generative AI, they will take share away from Adobe. And that is when you'll see a declining business in Adobe. So for Adobe, I'll be staying out of this one. I don't think I'll be investing into it, although I use their products. Last portion, I'll be talking about some questions that you guys have left me in the comment section below. So the first one over here, it says, "Hi Guan, Copart is currently trading at 52-week lows. Their fundamentals look great. Is slightly overpaying for them worth it?" So for Copart, it is currently now down 12% year to date. And post earnings, the stock is actually down around 22%. So this stock now is trading at 32 times of earnings. And for Copart, I think it is currently around fair value also. So for Copart, the business model is it's an online auctioning platform. And they recently acquired two businesses as well. One of it is called Blue Cars. The other one is called Purple Waves. So their Purple Waves portion is where they sell machineries, heavy machineries. And then for your Blue Cars portion is where they rent out the cars. Both of these are under your services revenue for Copart. And that is what is pushing up the services revenue for Copart. But for Copart, I'm not too sure why the management is not putting the cash into buybacks. They have a lot of cash and they're not deploying it into investments, nor are they doing buybacks as well. So they're just hoarding the cash at this point. I'm not too sure what the management is doing. Maybe they think the shares are still a bit too overpriced for their liking. So for Copart, I think it's a quality business. But Copart is a business that is reliant on accidents. And in the long term, if we see increased AV adoption, then that could be detrimental to Copart's business because your AV will be a lot safer as compared to your human cars. So for Copart, I'm just waiting and reading up on the stock. Maybe I'll find something that gives me a thesis to buy into this one, but currently it's just a wait and see. Next comment over here, it says, "If Google sells Chrome, they are not losing 50% of their search revenue. That's on the basis that all Google search coming from Chrome disappears, and people still using Chrome don't use Google search anymore." So the commenter also said that how does accessibility change based on the browser you use? And come on, Yahoo is not even similar to Google. Google may have to divest their Chrome. It doesn't really affect Google search. Chrome doesn't generate revenue, and other than Google being default browser, there's literally nothing else. You took the one analyst report and are just blindly following it. So this is what I replied to him. I said, I have quite a sizable position in Google. And yes, Chrome doesn't generate revenue, but Chrome is the intermediary that leads people to Google search. If Google loses Chrome, it's similar to iOS losing iPhone as well as Mac IP. The analogy wasn't very good, but you get the idea. Google Chrome is integral to the entire Google ecosystem. So Chrome is worthless to other companies, but it is a core part of the entire business itself. Yahoo couldn't innovate in time, and for Google, they have two headwinds. They have innovation risk as well as structural regulation risk. So if all these resolves and nothing happens to Google in a year, then Google will trade at 30 times earnings again. But when you're a shareholder of the stock, one must acknowledge the downside when holding on to the stock. Google is my largest position, but Google's risks are very real. So for Google, they have two main risks: regulation risk as well as innovation risk. They have to continually innovate so that they stay ahead in the AI race. And for the regulation risk itself, I think if they lose Chrome, it will be extremely detrimental to the business itself. While they won't lose the entire Chrome share in terms of Google search, it will be extremely detrimental to the business, and the stock could definitely drop 20 to 30% if that comes true. So for Google, although the valuation makes sense today, I think the stock is still a bit risky compared to other companies like Amazon, Microsoft, and so on. So currently I'm just waiting and seeing. Maybe I'll trim it when it goes to around fair value or so, but that will be at around $200 a share, which is still quite a while away. Last question, it says, "Great video. Can you recommend some books about stock market investing? Just getting started on my journey." So these are 3 books that I will recommend. So the first one is on Warren Buffett deals. Basically, he's just documenting all his early investments. He did some arbitrage plays as well. It was quite interesting. And the second book is also about Warren Buffett. In this book, the author actually highlighted a lot of the indicators that Warren Buffett wants when it comes to investing into a stock. It's quite an amazing read. You get to see all his tenets and all his criteria when it comes to picking stocks. And the last one is by Howard Marks, Mastering the Market Cycle. It's about how the market swings up and down in a pendulum shape. So currently now we are in an up cycle, and that's why you're seeing investors like Howard Marks, like Warren Buffett becoming a bit cautious. I hope you guys have found this one useful and invest safe.